Stop watching the silver price. Start watching where the metal is actually trading. Right now, today, China is pricing physical silver near $128 per ounce, while US futures hover around $111. That's a $16 to $18 gap. And it's not arbitrage noise. It's not currency math. It's a stress signal. Nearly 1 million ounces pulled from Comex warehouses in a single day. Shanghai premiums at historic extremes. This is happening in real time. If you're stacking silver, hedging exposure, or just watching commodities, this affects your position. If you're watching this video right now, you're ahead of 90% of the market still staring at price charts. We're not here to predict. We're here to teach you patterns you'll recognize again and again. The real risk isn't the price move, it's what happens if delivery breaks. Hit subscribe not for hype, but for protection. We're a group that watches flow, not headlines. Physical movement, not futures noise. The signals Wall Street ignores until it's too late. Here's what just happened. Silver futures in the US are trading in the low to mid 110s. Standard pricing. Nothing alarming on the surface. But in Shanghai, physical silver is changing hands near 128 equivalent. That's roughly a 15% premium over Comex, and it's sustained, not a one-day blip. At the same time, Comex registered inventories are draining fast. We're talking hundreds of thousands of ounces leaving warehouses daily. The kind of drawdowns you see when someone needs metal now, not contracts later. So why does this matter? Because futures reflect expectations. Premiums reflect desperation. When physical buyers in China are paying $16 to $18 over Western futures prices, they're voting with cash. They're not trading paper, they're taking delivery. And that changes everything. Most people watch price. We watch who can actually get the metal. Think about that. Comment watching if you track physical markets. I want to know who else is paying attention to this. Let me show you the mechanism. I call it physical override. Here's how it works. Paper pricing, futures, derivatives, ETFs acts like a valve. It controls perceived price. It's liquid, it's fast. It's where most traders live. But physical demand, that's a fire hose. When the fire hose overwhelms the valve, pressure doesn't disappear. It builds somewhere else. And that somewhere else is premiums. You see it first in delivery costs, then in lease rates, then in the willingness of sellers to actually let metal go at the quoted price. Right now, we're watching that play out. Shanghai premiums widening to $16 to $18 over Comex isn't random. It means physical buyers in China need silver more urgently than futures traders in New York are pricing it. The paper valve says 111. The physical fire hose is paying 128. And here's why this pattern repeats. Industrial demand doesn't negotiate with futures curves. A solar panel manufacturer in China doesn't care what December 2026 silver futures are trading at. They need metal in March. If it's not available at the official price, they pay up. They have to. So when you see sustained physical premiums, you're not seeing speculation. You're seeing real-world demand overwhelming paper pricing. This is how shortages start without headlines. Now layer in the inventory side. This is where it gets dangerous. I call this the inventory squeeze loop. Here's the sequence. Step 1. Physical demand rises. Warehouse withdrawals increase. Step 2. As inventories drain, lease rates start climbing. Why? Because bullion banks that lent out metal now have to source it to meet delivery obligations. And if the metal isn't sitting in the warehouse anymore, they're scrambling. Step 3. Tighter availability means higher premiums. If you're a buyer and you know inventory is thin, you bid up. You pay for certainty. Step 4. Rising premiums attract more delivery demand. Traders who are holding paper contracts start thinking, wait, I can get $16 more if I take delivery and sell physical. So they stand for delivery. Step 5. Delivery stress compounds. More delivery notices hit a shrinking inventory pool. The loop tightens. And here's the trap. Bullion banks often run fractional operations. They don't hold one-to-one metal for every contract they've written. They rely on most traders rolling or closing positions, not taking delivery. That works until it doesn't. Imagine you're a bullion bank. You've sold 10 million ounces of silver futures. You're holding maybe 2 million in allocated inventory. You're short 8 million ounces on paper. No problem, as long as 90% of longs roll their contracts forward or settle in cash. But now premiums are screaming. Comex metal is leaving. A higher percentage of longs start demanding delivery. Suddenly, you're not just managing a futures book. You're sourcing physical metal in a market where availability is tightening and premiums are widening. You're forced to buy at higher prices to cover shorts you sold at lower prices. Not telling you this leads to a squeeze, showing you the mechanics of how squeezes form. Liquidity isn't supply, and the market is relearning that right now. Think about that for a second. Liquidity, the ability to trade contracts easily, makes markets feel abundant. But when delivery preference shifts, liquidity evaporates. What looked like 100 million ounces of available silver in open interest becomes a scramble for the 30 million ounces actually registered in warehouses. That's the hidden layer. Premiums or price? Which do you trust? Drop a comment. Here's what you need to sit with. The real question isn't how high will silver go. The real question is, what happens if China keeps bidding and the West can't deliver? Because this isn't about price anymore. It's about credibility. If Comex futures say 111 and Shanghai physical consistently trades near 128, at some point the market has to reconcile that. Either Western sellers find a way to deliver metal and capture the arbitrage, collapsing the premium, or the premium persists, signaling that delivery into the West isn't functioning the way everyone assumes it is. And if it's the second scenario, then we're not talking about a bull market, we're talking about a pricing mechanism failure. The stakes aren't just silver goes up, the stakes are, does paper pricing still mean anything when physical demand overrides it? I can't tell you which way this resolves. Could reverse tomorrow. Premiums could fade, inventories could stabilise. But I can tell you this is where breaks happen. Quietly at first, then all at once. Not predicting. Watching signals. Your job isn't to front-run the break. Your job is to understand the structure. So when it happens, if it happens, you're not blindsided. Shortages whisper before they scream. Right now, they're whispering. Let me give you the scenarios. In scenario 1, normalization. Premiums fade back to $2 to $4 over Comex. Inventories stabilize. Withdrawals slow. The stress signal goes quiet. What this means is demand was temporary. Maybe Chinese buyers got ahead of Lunar New Year. Maybe Western sellers stepped up and delivered. The system absorbed the shock. Who wins? Traders who stayed liquid. Anyone who didn't panic. Who loses? Late longs who chase premium news into the top. In scenario 2, the grinding squeeze, premiums stay elevated in the $8 to $12 range. Inventories drain slowly but persistently. Volatility rises. Delivery delays become normal. What this means is the system is under sustained pressure, but hasn't broken. Think 2020 to 2021 in certain metals. Long periods of tight physical conditions without dramatic price dislocations. Who wins? Physical holders with time. Producers with pricing power. Who loses? Short-term traders fighting volatility. Leveraged longs who get shaken out. In scenario 3, a delivery event, premiums spike to $20, $30 or more. Futures disconnect sharply from physical. Exchange interventions. Settlement rule changes. What this means is the paper system couldn't absorb the delivery demand. We're in a repricing event. Who wins? Early physical accumulators. Anyone who positioned before the break. Who loses? Paper-only holders. Leveraged shorts. Anyone assuming liquidity would hold. Can't know which path we're on. Could be none of these. Could reverse. But understanding the paths is how you stay oriented. Now here's what I'm tracking. First, Shanghai silver premiums. Normal behaviour is $2 to $4 over Comex. That reflects shipping, financing, standard arbitrage. Stress behaviour is 15 plus. Sustained, widening. What I'm watching is whether the gap is stable or expanding. If it narrows quickly, stress is fading. If it holds or grows, demand is real. Second, Comex registered inventory. Normal behaviour is flat to modest declines with occasional inflows. Stress behaviour is sharp daily withdrawals, 500,000 to 1 million ounces out per day. What I'm watching is the trend, not the day. One big withdrawal can be a single large buyer. 5 consecutive days of outflows. That's a pattern. Third, silver lease rates. Normal behaviour is muted. Barely moves. Reflects low borrowing demand. Stress behavior is sudden spikes, jumps from near 0 to 2%, 5% higher. What I'm watching is, if lease rates are rising, bullion banks need metal. They're paying to borrow it. That's delivery stress showing up in funding markets. Fourth, EFP spreads, exchange for physical. Normal behavior is tight, maybe a few cents, reflects smooth arbitrage between futures and physical. Stress behavior is widening gaps, large and persistent. Signals dislocation between paper and real metal. What I'm watching is how much traders are paying to swap futures for physical. If that spread blows out, it means getting actual metal is hard. Fifth, delivery notices versus open interest. Normal behavior is orderly. Most contracts roll or close. Delivery is a small fraction of open interest. Stress behavior is a mismatch. Delivery intentions rise while inventory available for delivery shrinks. What I'm watching is the ratio. If 10% of open interest suddenly wants delivery, and only 3% of supply is available, that's a problem forming. Here's the interpretation logic. 1 signal flashing. Noise. 2 signals. Possible stress. Stay alert. 3 or more. Pattern forming. Reposition accordingly. Not telling you to buy or sell. Showing you what to watch. If you're a trader, respect the volatility. This environment can whipsaw. Tight stops. Flexible positioning. If you're a long-term holder, accept the pullbacks. Stress doesn't move in straight lines. Physical demand takes time to translate into sustained price moves. If you are just learning, focus on flow, not price. Build your ability to read signals before you build positions. Risk clusters I'm thinking about. Not trades, just hedges. Jurisdictional spread, exposure in multiple regions like the US, Europe, Asia. Time horizon spread, some short-term liquid, some long-term hold. Form spread, physical allocation, paper exposure. Mining equity, liquidity spread, some instantly tradable, some lockup accepted. Your approach will differ. That's fine. The point is layered thinking, not single bets. If you watch flows instead of price, you put yourself in the group that sees stress early. Not the group reacting to headlines, the group positioned ahead of headlines. That's the edge, not prediction, not perfect timing, just awareness. Have you seen shortages locally? Physical premiums spiking at your dealer? Let me know in the comments. Real stories matter more than theories. Quick recap. China pricing silver $16 to $18 over US futures. Comex inventories draining fast. Physical override pattern and inventory. Squeeze loop both active. Watch premiums, inventories, lease rates, EFP spreads, delivery stress. Multiple paths ahead. Could normalize, could grind, could break. Your job is to understand the structure, know the signals, stay oriented, hit subscribe. We're tracking this weekly. You don't want to miss the updates when these signals shift. Here's my final thought. Markets don't break when everyone panics. They break when no one's watching. Right now, we're watching. Price is opinion. Premium is urgency. Watch the exits, not the scoreboard. Links below. Let's stay sharp.